welcome back. Options Trading Pilot. Today I'm going to walk you through a few ideas when it comes to inflation, how to trade that. There are not very many vehicles unless you're a commodities trader, and even then it's kind of tricky. But we'll spend a few minutes looking at that. We are in the market today. It's a little bit slow, so you might hear some dings in the background. That's just some trades being executed. And you get to see my Eat, Sleep, Trade, Repeat shirt. It doesn't just say eat. So anyway, so this is the trading day. So let's see what's happening in the markets. So again, Options Trading Pilot, where we help people in honest, direct, distinct, well-defined ways, strategic, mechanical ways of trading. So okay, so let's get into a few things to talk about. Let's take a look at the markets are open, so we can actually see some things popping around. Over here on the left of the screen, I have all the futures. So all the way from, here's Bitcoin up 7% today. Let's make this a little interesting so you can see the graph going up. Big move up today in Bitcoin. And that's actually the Bitcoin futures. This is one of the products we're going to talk about. Then we have Ultra Bonds. These are all futures markets. This is a commodity-based index for gold, silver, and platinum. And then you have other things like this is the NQs, which is the NASDAQ 100 futures. And I do trade a lot of this. I'll save that for another conversation. There's a trade right there. So this SI, this is a silver in the futures commodities world. The Z1 talks about what date that refers to. So just to give you an idea, there's quite a few futures if you ever want to trade futures. But let's keep this to a very simple. I've created a little watch list here. Now, I watch VXX, and what this is, it's a short-term futures. It's an exchange-traded note, but you can trade options on this. So how it works is if the market is rapidly going up, the VXX, which is like similar, but not exactly the same to the VIX. So you hear about the VIX. And why that's important is volatility is one flat factor in the Black-Scholes model that defines how a option is priced. So if the VIX is up high, like a high number, then that high number works into making a higher value for the premium in stock options that you're trying to sell. So right now, the VIX, the VXX is the thing that you can actually trade. VIX, very similar, but not very tradable. It's just a hard thing to trade. I can go into that if people want on a future conversation. But the VXX is much easier to trade. Very small bid ask, a lot of volume. So again, if I'm looking at, I think the market's going up, that means, well, let's look at it this way, because today the market's down. So right now the VIX is up a small amount. So, but if I think the market's going to continue to go down, then I can buy or sell options related to that. So if I think the market's going to go down, that means VIX will go up. So I can come in here. Right now, the market's at 26, the VXX price. The 24s are sitting at 30 delta. That means there's a 30% chance that the VXX will trade under 24 before November 19th, which is 44 days to expiration. I could take that trade naked or uncovered, and put $166 in my pocket. But you can see here that that cost, while I might make $166, my max loss is $2,200. So what I can do to add a little protection, a little inflation, not inflation, but protection on this stock or this index really going against me, is I buy a put further out of the money. So now my max profit is lower, but my max loss is dramatically decreased. So we're looking at a point right now where we have crude oil, and that's going to be our big driver. It looks like here, crude right now is off quite a bit today, but it has gone up quite a bit, as you can see here. Just a month ago, we're looking at $68 crude. It hit 70, 79 almost, and it's backed off that a little bit today. The IV rank is 23, so these are tradable future markets, very easy to do. If you look, they act and look just like stock options. So the big trick is commodity futures trading and options might sound exotic, but they really work almost the same way. There's a few nuances, but it works almost the same way. So you learn the basis in one, it applies to the futures market here. But let's go back to some of the things if you don't have a futures account. Gold. Gold is one item that it has been pretty choppy lately. But this is something that if you think the inflation is coming back, gold has historically been a hedge for that. It will remain to be seen if that will be the case this time. Now we have Bitcoin and several other currencies, cryptocurrencies that may or may not act as an inflation hedge. There's a lot written on that, but let's just stick to the basics for today. So gold is a hedge. And if you believe that, you think gold's going up, you can go out. Again, one of our philosophies, our methodologies is going to a 45 days to expiration. And we would take this off at 21 days to expiration, 50% of the max gain. So let's say I think, oh, gold's going up, it's at 165. So here we are at the market right here. You see there's not much volume here, but I could go down. Let's just say, for example, I go right to the 164. So if I want to be a premium seller or collector of money, IV rank is over 20. So that means that's great for us. The bid ask 281 to 284, that's good. And not a lot of volume, but a fair amount of volume. So what I could do on this, if I'm bullish on gold, I sold the 164 November 19. It has a 44 delta, so that's getting to be 56% chance that it will not go under this. That's kind of tight. So if you're really bullish, that would be the trade. I most likely would come in here. This tan line is the expected move, the 24 delta. So that's about a 75% chance that it will not, GLD will not go under 159 in the next 45 to 44 days, so November 19th. So I would come in here and I could buy or sell this for $1.30. So my max profit here, $128, but my max loss, theoretically, if it goes to zero, which it could, but the statistical probability of that is about zero, but your max loss is 15,007. So what one could do is come in, say, let's go out 5 or even 10. If you really want to keep this more like a naked position, say go out 10 points and go to 149 and just buy a little protection in there. So what that does, now you reduce your max profit by $30, but your max loss is dramatically limited, because now if it goes under 159, you have protection because you've actually bought at 149. So that helps with the protection. Another area is silver. Silver right now, a little tricky because the IV rank is 6. So it's not really a good credit play, meaning if I come in here, and you can see this, if I go out the money and go down a few points, I'm only getting a profit of max profit of $22 with a max loss of 278, or 10 times that amount. So this is not really a good trade. And that's why we look for IVR, IV rank, higher than 20, because if you're going to sell premium, you want to take an amount of risk that will pay you for the amount of risk you're taking. So what you'd have to do in this case, if you're bullish on silver, you would have to actually come in. And what we usually do is we'll go in one strike into the money. And then this is kind of personal preference, but you'd buy that and come out here. Let's say the expected move is 22.5. So maybe I'd come in here and sell the 22. So there your max profit is 84. Your max loss is 66. The 66 is the net of what you're spending. So you're buying the 20.5 call, but selling, getting some premium in on the 22. So that would be a debit call spread. Now there's a few other ones as we're looking at oil. Oil is choppy, but it has been going up. I think it will continue to go up. The short-term rates in the this is the 10-year, it's a small product. It's a 10-year treasury yield. So bonds and yields are inversely related. This product, if this product goes up, the interest yield, actually yield is going up. So it's a different type of product than we're used to trading. But what's nice about that is it makes it real simple. You think interest rates are going up, you would buy into this future. It does not have any options at the moment, but you can buy into this future. You think interest rates are going up, and you would buy that. So now we're at 1.53%. That equates to a 1.53 or 1.54 on the 10-year yield. So we are at multi-year highs in the yield products. I think we're going to continue to see bonds degrade. Oil will go up. Commodities, I think, are going up. This is the purpose of this discussion. I could be completely wrong tomorrow. But this is one thing I'm looking at is copper. This is a ETF. It's not a perfect view of copper. The futures market is better, but for most people, the copper market is CPER. And you can see not much going on with copper. A lot of volatility, but not really making new highs. So you have oil making new highs, gold and silver not, copper's really not. But you see a lot of inflation. So there's some other products. This is an Invesco commodity tracking fund. This has a lot of oil products in it, but it really has a full slew of commodities. So you have soy, corn, wheat, gold, silver, platinum, oil. So if you don't want to trade the futures market directly, DBC is something that I like quite a bit. And you can see that it's gone very well. Even before we were talking about inflation as a country, it knew what was going on before that. Another one I like quite a bit is PDBC. This is another product by Invesco. And this is also, it's an exchange traded commodity fund. And I believe this one has, no K1. So you will not get there's no partnership. You're not getting a K1. This would act just like any other investment that you get on a 1099. So I like this one quite a bit. So I look at the VIX. I look at the S10Y, interest rates going up. I look at copper, not really telling much of a story just yet. But if I see copper starting to uptick, that'll be a reconfirmation of across the board inflation, because copper is in so many items. And then what I'm playing for my day-to-day trades, I trade in the commodities futures market, but for longer term holds, medium-term holds, I use DBC, and I use PDBC for commodity exposure without all the commodity complications of the futures market. So that is it for this episode. Hopefully it was very interesting and informative. Please leave some comments below, click subscribe, let us know what else you'd like to see. OptionsTradingPilot.com is the name of our company. We also, on our site, you can see that we post out our trades all day long on Discord. Thank you very much.